We see the major risk in the market is global growth. The global economy, in our opinion, is in a downturn, and it's being driven by policy decisions, and primarily the trade policy. That's really what has caused the world to go through a manufacturing-led slowdown. Of course, tariffs cause that, but it's also the uncertainty. And right now, it's difficult to say. There's no signs right now that those negative headwinds are abating. The danger is that it would spread to the consumer side and lead to higher unemployment and a weaker economy. And of course, from a financial market perspective, that would put pressure on riskier assets like equities and, of course, the credit markets through weaker credit fundamentals. So we're keeping a close eye on that. We think we can avoid a deeper downturn, but I would say the risks are tilted to the negative side. We think active management is really critical during the later stages of the credit cycle. Of course, we think it's important throughout the credit cycle, but particularly at the late expansion phase, because if you think about it, moving from an expansion to a downturn when valuations in the market are fair at best and maybe a bit stretched requires some degree of caution. First of all, we're starting with very low yields. We're all aware that there's a significant amount of negative yielding instruments around the world, mainly outside of the United States, and that's dragging down yields across the globe, including in the US. Secondly, because of that demand for carry, investors are really pushing to take on risk in less liquid areas and down in quality, and that's compressing the risk premium that you normally would get in areas like equities and credit markets. When we're selecting individual bonds, we're looking at how particular investments can behave and can they hold up well in a more negative scenario in terms of the economic conditions. And in terms of our portfolios, that's why we're adding a degree of caution in our portfolios through building reserves, having liquidity there, and high grading our average quality.